topic today is the CARES Act grants and the updates that we've received in the last probably 30 to 60 days on the reporting requirements. So going on our agenda today, we are going to try to get through a couple things. We're going to go through a very brief overview of the CARES Act COVID relief funds. If you've been in presentations before, obviously now we're going to spend less and less time on an overview and just kind of go over some of the open programs. Moving quickly into the reporting requirements for PRF recipients and the latest updates that have been published to the frequently asked questions. And hopefully, if we have enough time at the end, we'll get to some of the frequently asked questions we're getting from clients and providers. So with me today, I'm Andrew Kent, shareholder here at Saltmarsh Cleveland & Gunn. I have with me, as Nancy said, Claudia Reingruber, who's managing director in our healthcare practice, and Al Grimes, who's a director based in Brentwood, Tennessee. All right, guys, so we'll get started. So the next slide, I think, Claudia, you're going to kick us off and just give us kind of a quick overview of the currently open provider relief funds.
All right. When we look at a lot of the provider relief funds are already closed, so there are just a few of them that we're going to mention here today. And one is that there's the $2 billion incentive payment plan for SNFs. And this is something that you do not need to apply for. It's a payment that's made automatically based on data that eligible SNFs already submit into the that are part of the CASPER system and Nursing Home Compare. So eligible SNFs will have a COVID infection rate that is less than the rate in their county, and will have a mortality rate that's below the nationally established threshold. And there will be 5 separate distributions, and we've already had 2 of them that have been issued up to this point. There are monthly distributions that will be made for the months of September, October, November, December, and then the 5th one will be considering all 4 months data combined. And 80% of the incentive payment is influenced by what the infection rate is in your facility compared to the county. And 20% then will be based on your mortality rate compared to the national mortality rate. We saw that initially the first distribution was made on October 28th, and it was about $333 million. The second round was considerably higher, and that was about $523 million, and that was paid on December 7th. And these payments must be used for infection control expenses. And there's more information that's available here in this little tiny link we put on the bottom of the slide. I think that's very important to recognize that there are still 3 more payments that will be made, and to make sure that all the information that you enter into the nursing home, the NHSN system, is accurate, because that's what is going to be used to base these payments.
Excellent. Wow.
And another important thing that is still available is the AHRQ ECHO National Nursing Home COVID Action Network. And this was intended, or the objectives of this is in order to prevent COVID from entering nursing homes where it's not been detected, to identify residents and staff who have COVID, and to prevent its spread, and so that we can keep our resident population as safe as possible. And this is a completely free program that will be offered for participants. There's small groups that are going to be have access to subject matter and quality improvement experts. Even though this is not it's a free program, you are also able to get up to $6,000 in provider relief funds for your staff that actively participate in this program. So, and they will also, participants will receive CEUs. There are some introductory webinars that have been held mostly in the month of October and possibly into November. All of those recordings are available on the website that we have on the bottom of the slide. And but registration closes on December 18th. So these are really small groups, probably 30 participants maximum. They'll give you access to these experts in quality improvement and subject matter experts that can really help you improve your infection control practices. And the program will be updated as it proceeds with the latest information that comes out. So it's an opportunity to have the $6,000 in salary costs reimbursed and to avail yourself of the latest information that can help you do the best possible job with infection control. So just keep that date of December 18th, 2020, which is coming up pretty quickly, and make sure you enroll if you have not done so already. And there are some other available resources. This one is the National COVID Training Program for SNFs. This doesn't involve any actual dollar resources or provider relief funds, but it's targeted training for frontline nursing home staff and management. And it's kind of interesting to note that the frontline staff have 5 modules that they can complete, but management has 10 that they will need to complete. And once these training sessions are completed, you will be able to obtain a certificate that you can post in the facility as evidence of your participation. And there's a website on the bottom of this slide also that will provide more information regarding this. And these are bi-weekly webinars by experts through January 7th of 2021. And with that, I will turn it over to Al.
Claudia, just a point of reference, I think you touched on this, but there was a little bit of confusion around this early on. There's like you said, there's no specific money associated with this program. It's just the training and the certificates, right?
Yes, that's right.
Yeah. All right. And I think from there over to Al. Al, you want to fill us in a little bit, start us off on the reporting requirements.
Sure. Good afternoon, everyone. Well, the reporting requirements for the PRF funds have remained consistent since the last couple of webinars that we've had. Because of the number of changes, though, that have taken place as far as modifications that have been issued, sort of piecemealed, we wanted to put down a sequential list for you. And just reading them in sequence, on 7/20, the detailed instructions were said to be going to be released by 8/17/2020 for reporting requirements, and that didn't happen. Then on 8/14/20, they did issue an update that eliminated the date detailed instructions would be released and stated instead they'd be released sooner, which also didn't happen. Both of these notices also stated that a reporting portal would be open by October 1st, 2020, which we all know didn't happen. Now, 9/19/2020, they issued an update that indicated the issuance of specific instructions had been delayed in order to consider provider feedback. Now, among these things that they did issue on 9/19 was that the definition of lost revenues was going to be a negative change in year-over-year net patient care income. This would have resulted in each provider getting basically leveled up to their 2019 net income. And it would have resulted in a net zero gain or loss in net income for providers. If you reported a net loss in 2019, they would allow you to receive enough to break even to that amount if you had in 2020. Now, on 10/22/2020, they issued a change in definition of that aforementioned lost revenues from a month before, where they modified it to permit PRF payments to be applied against lost revenue, net of expenses attributable to coronavirus, not otherwise reimbursed, up to the difference between 2019 and 2020 net patient care revenues. And then again on 11/2, we had another update, which eliminated the step to net unreimbursed coronavirus expenses against lost revenues before computing the difference between 2019 and 2020 net patient care revenues. So in effect, our example that many of you saw in our previous webinar that was several pages long, I believe, Andrew, you got to adjust it a little bit to where it's significantly shorter.
Yeah, but I think everybody probably on this call is probably aware of this by now. But as Al's kind of walked through, the notice published on September 19th represented a major change from the guidance that we've been given earlier. And of course, we were all reacting to that, I think, at the time and at the time of the last webinar. There was apparently a significant volume of industry feedback. And as a result, HHS reversed their September 19th position, as Al's kind of outlined, and has fallen back to this, this defining lost revenue as actual lost revenue. With the caveat now that unlike some of the earlier guidance that we received, providers are being limited to a very strict year-over-year comparison. And we're going to get into that and the mechanics of that here in just a bit, but that has been a major change. Al, are you ready for the next one?
Yes, please. So the reporting requirements for the PRF funds, these particular funds that are listed on this slide have their own definitive level of reporting that's required. General distributions, targeted distributions, including high impact, rural, SNF, Indian, health, safety net, and each provider must total any amounts that you received from the general and then any individual targeted distributions that you've received from above. Now, an update to the general and targeted distribution post-payment notice of reporting requirements was issued dated 11/2/2020, and it's been issued or has been posted to the HHS coronavirus website, which we have a link to or write out the link in the latter stages of the webinar. RHC is excluded from the rural distribution instructions, defined level, and also under SNF, the infection control distribution has been excluded. They have stated that specific guidances for these may be issued in the future. And if we could go to the next one.
And Al, just as a point, and most of I think probably most of the audience on the call today, if you almost everyone on this call has probably experienced either payments from the general fund, the general distributions, or the targeted SNF distributions. And so if you got either one of those two, you're going to be subject to these reporting requirements, right?
Right.
Yeah.
And there's really been little change in this particular slide from previous webinars. There's 3 reporting levels that based upon the type of PRF funds received. If you have less than $10,000, there'll be no reporting requirement. If you receive between $10,000 and $499,999, then you're going to have to report the COVID-19 related expenses that haven't been otherwise reimbursed, lost revenues, which is the negative change in year-over-year actual revenue, which is a change from the previous slide, and we detailed that that's from the memorandum dated 10/22, and any other specific financial and non-financial data, which we discuss in later slides. If you have 500,000 or more, you're going to have the same categories as above, but there will be more detailed required. And HHS still maintains that they will have webinars, and we're going to ask questions before the reporting deadline. Now, those reporting deadlines, if we go to the next slide.
Should be there.
Yeah, well, that's with your eyesight. You don't have my prescription. The key reporting dates haven't changed from our previous webinars in that the reporting portal is scheduled to be opened effective 1/15/2021. Then as of 2/15/2021, that's going to be the first reporting deadline. And that's for funds fund use through the end of 2020, through 12/31/2020. However, if you haven't expended all of your funds as of that date, as of 7/31/2021, that's going to be the final reporting deadline. And you can also include, and Andrew, correct me if I'm wrong, but if you haven't expended all of your funds through 12/31, you can actually include expenditures made through 1/1/2021 through 6/30/2021 if you use the last reporting deadline.
Yes, so that is correct. And so as Al's described, if you haven't, once you get through the first reporting cycle, if you determine that you haven't demonstrated use of all your PRFs, you will have the first 6 months of 2021 right now to continue to demonstrate the use of those funds, and we'll have one more reporting cycle at that should be open. Now, Al went through a list earlier of all the dates that have been missed thus far, and I think if you were probably to ask Claudia and Al and I what we think the realistic, how realistic these, HHS is going to be able to adhere to these reporting dates, it will be interesting to see if they can meet these deadlines. There's the 1 month between the portal opening and the February 15th deadline. There are thousands of providers who are going to be in that system trying to report data in that 30-day period, and that is going to be I think a real challenge. Al, anything else on this slide?
Just that the single audit be required for recipients that have expended $750,000 or more in federal financial assistance in 2020, and we'll discuss that on some later slides.
All right.
I think, Andrew, you were going to take the next one.
Yeah, I think I've got the next couple here. So what must be reported? So so you've got to remember, you've got a couple things going on here. Our guidelines, the guidelines that have been published so far are generally around reporting. And so there are 4 basic categories of data that has to be reported. There's demographic information. There's reporting of expenses attributable to coronavirus that haven't been reimbursed by other sources. There's information to support the calculation of lost revenues related to the coronavirus. And so that's going to be your annual revenue and expenses, total revenues and total expenses for 2020 and 2019, and then possibly the first 6 months of 2021 as well. And then there's some additional non-financial data elements. And so we're going to take a few minutes and walk through these and with some kind of breaks or outtakes, because a lot of this is the same. If you had joined us a month and a half ago, a lot of these basic categories are the same, but we do have some FAQs that kind of highlight or starting to give us a little more direction here on some of these. So we're going to try to take some time and go over those as well. So one thing that has been clarified is that providers will report data using their quote unquote normal method of accounting, cash or accrual basis. So this is still an area where, and we have seen this in other similar government programs as well, but this is probably going to be an area of large question mark. Basically, the government is telling us to use your normal method of accounting, and it can be either cash or accrual. Many of you may use both methods. You may run a set of cash statements and a set of accrual statements. Most of you are probably on the accrual basis, but then there's a question of, can you use one or the other? If you do run 2 sets of statements every month, can you pick and choose? How do you make the decision which one to use? If one is more favorable, do you get to have a choice? So these are questions where we don't have guidance on these kind of issues yet. And I think, based on some prior experience, those issues can become, they can become very important.
If I could just add a comment to that,
Sure,
Andrew.
of course.
One of the things that I think is interesting about this particular statement is that as a Medicare and Medicaid provider, as far as I know, you are required to use the accrual method of accounting. So for reporting purposes, so that seems like a little bit of a disconnect between the usual reporting requirement for providers who are reimbursed by those, those state and federally funded programs.
Yeah, no, that's a great point, Claudia. I mean, I believe all cost reporting is on accrual basis, and so why they're making this distinction. Anyway, it's going to be interesting. But we know there are a lot of small providers who function on a cash basis, even if they theoretically should be on an accrual basis. There's a lot of inconsistency in financial reporting, especially for smaller providers. So it will be interesting. Coronavirus-related expenses. So your coronavirus-related expenses may include those expenses incurred in treating confirmed or suspected cases. Do y'all still have my video? I'm going to keep going. I think I may have lost my video, but may include expenses incurred in treating confirmed or suspected cases, preparing for possible or actual cases, or maintaining health care delivery capacity. Both G&A expense and healthcare operating expenses can be included. And there's a frequently asked question, I think we're going to touch on this later, Claudia, that allows you that gives some detail on how to allocate, or that you can allocate G&A expenses from a home office. Expenses are reported net of other reimbursed sources. And other sources could include payments from insurance, patients, federal, state, or local governments. We're going to talk about this in a little more detail here in a few minutes. And the reporting will be, the initial reporting is for 2020, and then possibly January through June of 2021. However, to report for 2020, you're also going to have to report those same expense categories for 2019. So even though the guidance says you're reporting for 2020, you're going to end up having to report for at a minimum 2 years, possibly 2.5 years if you roll into 2021. So going on to the next slide. The expense reporting threshold. So as Al discussed, there are some expense reporting thresholds. For providers who got more than the $10,000 but up to the $499,000, you can aggregate expenses into two of the basic categories, G&A and other healthcare expenses. For providers who received more than $500,000, you're going to have to provide some additional detail on those expense items. And we're going to talk about that in the next slide. So if you got more than $500,000 in provider relief fund payments, you need to provide detail. You're going to be required to provide additional detail. You can't aggregate in just G&A and healthcare related expenses. And so this slide kind of outlines some of the additional detail that providers are going to be expected to report on. For example, you're going to have to provide detail on the G&A side, on mortgage or rent expense, insurance, personnel, fringe benefits, lease payments, utilities, and any other G&A expense. On the healthcare side, once again, rather than just being able to report a line item for healthcare expense, you're going to have to report on supplies, equipment, information technology, facilities, and other direct healthcare related expenses. So they're going to expect more line item detail. And once again, this is something that is starting to get addressed in the frequently asked questions, and we'll have a little bit more detail on that. So detailed expense reporting. So there's been a bunch of clarifications in the FAQs, and so Claudia, if you can help me with this, maybe we can work through this together. Can the provider relief funds be used to support COVID-19 vaccine distribution? Oh, you're on mute, Claudia.
So I guess you didn't hear me then.
No, didn't hear you then.
So there has been, most of these frequently asked questions that we're going to talk about have been added since the last seminar. And this one was added in the end of October, and it said that, yes, these PRF payments can be used to support the distribution of the vaccine. as the vaccine becomes available. So if you need to purchase things like additional refrigerators, or if you have additional personnel costs to provide these vaccines, or acquiring the doses of the vaccine, including transportation costs not otherwise reimbursed, you can use the PRF funds to cover those costs that you're not getting covered in another way. So that's something you want to keep in mind.
Excellent. So can the PRFs be used to pay for vaccine doses and administration fees for Medicare, Medicaid, and CHIP beneficiaries?
No, they can't. Based on the terms and conditions that came along with those provider relief funds, they can't be used to reimburse expenses or losses that have been reimbursed from other sources, or that other sources are obligated to reimburse. So Medicare and Medicaid and CHIP are obligated to reimburse for those. So you would not be able to use the PRF funds to pay for those vaccine doses and administration fees. And that was also added at the end of October.
Is there a set period in which the providers have to use the PRFs?
Yes, there is. This is a change from, this was modified and at the end of October. So provider relief funds have to be expended no later than June 30th of 2021. The previous FAQ said that it had to be, those funds had to be used by the end of the public health emergency. So I'm not sure if that means they're not sure when that public health emergency will exactly end, but in any event, you have it through the end of June 30, 2021. Only to use those PRF funds.
Yeah, that is a clarification, I think, of probably a conflict in the previous guidance, Claudia, because I think the previous guidance provided that the second reporting period would be through June 30th, but then you also had this definition of the through the public health emergency, and so I think maybe they were trying to clean some of that up. Can the PRFs be used to repay accelerated or advanced payments?
No, and I think they added this question, this FAQ to the list because there was one little statement that inadvertently got published by HHS that said it would be permissible. And they quickly clarified that and said that no, you cannot use PRF funds to repay accelerated or advanced payments.
Can the PRFs be applied against total expenses for capital equipment or inventory?
Okay, now this one was added on November 18th, and I think this is a very important clarification. And the answer is maybe, sometimes. It's not a definite answer of yes or no. So expenses for capital equipment and inventory can be fully expensed only in cases where you purchase those items and they were directly related to the need to prevent, prepare for, and respond to the coronavirus. So examples of these types of equipment and inventory expenses could include ventilators or computerized tomography scanners, ICU related equipment, which won't apply to the nursing homes. And there could be other items that you would normally might hold in inventory. I know there are a lot of nursing homes on this call, and oftentimes we don't really have an inventory account. But if all of the expenditures that you have for masks and face shields, gloves and gowns, and biohazard suits, PPE and disinfectant supplies, you're probably undoubtedly buying way more of that than what you would have done previously, and have a stockpile of that so that you'll have adequate supplies and PPE for, as this public health emergency continues. So that's a very important clarification, and so that's one you're going to want to keep in mind.
Along the same lines, can the PRFs be applied against the total cost of capital facilities?
And the answer to that is also maybe or sometimes. And which is interesting, the expenses for capital facilities may be fully expensed, but only in cases where the purchase was directly related to preventing or preparing or responding to the coronavirus. So for example, if you had to upgrade or your heating or ventilation or air conditioning system, so you have negative pressure units, then that would be able to be fully expensed against your PRF funds. If you had to retrofit a COVID-19 unit, we've seen instances where facilities have taken over or are utilizing with state approval ALF beds or other kinds of facilities to expand to have a COVID-19 unit. So anything you did to retrofit that would normally be considered a capital expense to create that COVID unit can also be applied against the PRF funds. If you have to lease or purchase a temporary structure to screen and or to treat patients, then those can also be expensed. And if you're leasing a permanent facility to increase your nursing home or hospital capacity, that is something that can also be fully expensed. So I think these two, this one and the preceding question, are very important clarifications to keep in mind as you proceed.
Yeah. Is there a limit to the amount of salary or employee compensation to which PRFs can be applied?
Yes, there is. And this is part of the terms and conditions that you had to sign for each of the distributions. And this is part of the rules and regulations that apply to grants. And there's a limit in compensation to an individual person that is set at an executive level 2, which is currently $197,300. So this the salary limitation, though, is applied to direct salary. It doesn't include fringe benefits or other kinds of indirect costs, and it doesn't limit how much you can pay to an individual employee. But it just means that you have to cover those higher salary costs, direct salary costs, with non-federal money, or you can't use your provider relief funds to cover those.
Right. And the last question that we have here: can parent overhead costs be allocated to entities that received PRF funds?
Yes, and I think this is another important clarification. This was issued at the end of October also. And it says that one thing, I'm going to read this exactly how it says, because I think that this will require some future clarification. But the answer says providers that already have a cost allocation methodology in place may allocate normal and reasonable overhead costs to their subsidiaries, which may be an eligible expense if attributable to coronavirus and not reimbursed by other sources. So there's not a real clear indication here in the FAQs as to what it means when it says you have an established cost allocation methodology in place. You know, there are some nursing homes for Medicare cost reporting purposes, for example, who don't always file a home office cost for Medicare purposes, may not file a home office cost report, and just exclude those overhead expenses from the parent that would be otherwise allowable. So I think this is something that you really want to keep in mind, and make sure that you don't overlook those kinds of costs that can be that may be appropriately used or covered by provider relief funds.
Yeah, and Claudia, there's a number of issues I think in there for providers. One is the allocation methodology, which you're talking about. Then, the demonstrating, whether or not there's been an increase related to coronavirus and how much of an increase is related to coronavirus. And then you also have the application of funds from other sources. So there's a lot of potential question marks in how allocated overhead costs will be handled. And just before we go on, I'll just say there are a lot. We're starting to get folks are putting questions in the chat. Please feel free to add questions in the chat. If we can get to them at the end of the presentation, we'll get to as many as we can. Otherwise, we will be reaching out to everybody. We'll kind of aggregate all these. What we do is we aggregate them all, and then we send them out to everybody in an email after the fact. So please continue to shoot us questions. All right, excellent. So lots of detail there, as you can see, lots of movement. We got the big picture notice, and then HHS is starting to kind of feed us some frequently asked questions that are clarifying these issues as we come up. And as we're going to see here in a minute, we think there are going to be lots of other clarification needed as we get down the road. So support for the lost revenue calculation. So we've been talking about expenses. Support for the lost revenue calculation. So once again, this focuses on reporting. The HHS is going to require you as a provider to provide them with documentation that supports the lost revenue calculation. And so, as Al noted earlier, lost revenues are now defined as the negative change in year-over-year actual revenue from patient care related sources. Your providers are going to be required to report revenue from patient care. So even though this is an important distinction, in the previous version of the September notice, we were calculating lost revenues as lost net income, or the change in net income. Well, net income is revenue minus expenses, and so you had to report both. We've backtracked a little bit now, and HHS is back to a lost revenue definition but they haven't changed the reporting requirements. Providers are still going to be required to report both revenue and total expenses for 2020, 2021, or 2020 and 2019, since we're doing a year-over-year comparison, and possibly the first 6 months of 2021 as well, if you have unused provider relief funds and you need to roll over into 2021. So all very important. Even though now we're in a seemingly a simpler definition, the reporting requirements have not gotten any simpler. You're still reporting both revenue and expenses. Reporting patient care revenue. So providers are going to have to report charges for healthcare services and supports as provided in a medical setting at home or in the community. The revenue should be reported as net charges, i.e. net of bad debts. You're going to be required to break out revenue by payer mix. So Medicare Parts A and B, Medicare Part C, Medicaid, commercial insurance, self-pay, and other sources. We now have clarification in the frequently asked questions that your patient care revenue is going to include that revenue from other sources. And that those other sources, we're going to talk about them in just a second, are pretty broad. Claudia, anything you want to add here?
Yeah, I'm sorry, Andrew, I was on mute again.
Yeah.
I was just going to mention that when you look at this, that they talk about net charges, which, for those of us in the accounting world is kind of an odd term because it's really, charges are one thing, our gross charges, and then we have contractual allowances that bring that down to our net revenues, what we actually collect or expect to collect. So it's important to kind of keep that in mind. It's not just net of bad debts, but it's also going to be net of contractual allowances. So it's really the net revenue that we're talking about.
Yeah, thank you, Claudia. Good clarification. All right, reporting patient care revenue. So these are some items that were in the frequently asked questions, and I think Al, you and I were going to run through these real quick.
Yes, the first one is interest earned on a PRF, a reportable revenue source?
So the answer there is yes. If the funds were held in an interest-bearing account. So if you took your PRF funds like many did and dropped them in your operating account and that doesn't earn interest, then you don't have anything to report. But if you took those funds and put them in a separate account that does earn interest and you earned interest on that during the period, that is a reportable item.
Or can I use 2020 budgeted revenues to compute my lost revenue?
No, this is a big change. So this is one of the major changes. Back in many of you will remember back when you were reporting your first attestation round. If you got general distribution funds and you had to report the first attestation, in that reporting you were required to estimate revenue for March and April, estimate your lost revenues for March and April. And the guidance that we were given at the time basically said you can use any reasonable methodology. And they gave examples, I believe, including, a budget, year-over-year budgets, our budget to actual, a year-over-year comparison, a budget to actual comparison. This has been a major change. You're now providers are locked into a 2019 and 2020 comparison. So no, you can't use budgeted revenues, unfortunately.
Well, can fundraising revenues, grants, or donations be included in patient care revenues?
So this is another recent clarification, and the answer here is yes, provided that those funds were used prior to COVID to support patient care services, then they can be included. Then they're to be included in patient care revenues.
Should prior year settlements be included in net patient revenues?
So this is another recent clarification, and the answer is no. You cannot include revenue related to patient care that was not provided in either 2019 or 2020, or presumably 2021 as well if you end up rolling over into 2021. So if you have settlement revenue in either of the periods, in any of these periods that you're reporting on, 2019 or 2020, if it's not related to care provided in 2019 or 2020, you have to exclude it.
If PRF funds are fully used to cover expenses, do we still have to report revenues?
Yes, you do. You're not off the hook, unfortunately. No, that is a clarification. Once again, the guidance here is focused on reporting requirements. And so if you, depending on what threshold you're in, you have to meet the reporting requirements for that threshold. So if you're, between 10,000 and 499, 999, you have to report at the consolidated level. If you're over $500,000 or over, you have to report at the detailed level. And there's no exclusion, even if you can demonstrate use of the funds.
Well, if a business records prescription sales, can that be included in revenue from patient care?
So the answer there is generally no. And I think what they're getting at there is if you essentially have something that is a pass-through, that is more of a retail revenue not related to the delivery of patient care, they cannot be included. And there is a frequently asked question on that issue as well. Claudia, or anything you want to add to any of those? No. All right. So those are some of and these are questions we're seeing from clients, or questions that have been in the most recent, some of the frequently asked questions that were published in the last month or so.
One comment, I'm sorry,
Yeah.
Andrew, one
No,
comment
go
I
ahead.
might add, I don't know if we mentioned that, but the most recent clarification was issued, I believe, on December, I'm looking for my date, December 4th is the most recent update. So if you're looking at a version that was issued prior to that, and there are many, many, many versions, that's the most recent one. So if you go to the Department of HHS and go to their FAQ link, which is on that page, you'll be able to access the latest version.
Yep, absolutely. All right, thanks, Claudia. So reporting other assistance in 2020. So you're going to be required to report all your coronavirus-related related assistance. And so this is going to include any money you may have gotten through something like the Small Business Administration, the Treasury Department, or the CARES Act Paycheck Protection Loan Program. So, one important clarification there. If you got a PPP loan, it is not revenue from an income tax perspective, but you're going to have to include it in revenue for CARES Act reporting. That is presuming, of course, that your PPP loan has been forgiven. If you got a PPP loan and for whatever reason it wasn't forgiven and it was just going to be termed out as a loan, then that is not revenue, because you don't have the grant aspect of the PPP loan. Any money you may have gotten from FEMA, other CARES Act or coronavirus-related testing reimbursements. So if you got payments or reimbursement for testing expenses, you have to include those. Any other local, state, or tribal assistance programs. So many of our clients are in states where there was a Medicaid supplemental payment for coronavirus-related expenses. So if you had a Medicaid supplemental payment, you would have to include that as other revenue. And then any kind of business insurance payments. This is something we don't see very much of. Most providers found out very quickly that their business income loss policies did not cover viral events. So reporting total expenses. Providers are going to be required to report total calendar year expenses for 2019 and 2020, and then once again, possibly January through June of 2021. And I'll just note real quick, I had a quick question here. I'll address this one. The comparison is always back to 2019. That is something that's been clarified. So you're required to report all your calendar year 2019, and then all of 2020, and possibly January through June of 2021. And you're going to have to report them by quarter. The expenses that are being reported are in two basic categories. You got your G&A and your healthcare related expenses, very similar to what we discussed up in the coronavirus related expense section. The key thing to remember here is that you're reporting all expenses. It's not just expenses that were reimbursed or expenses that were related to the coronavirus. It's all expenses, whether or not they were related to the coronavirus. And so from here, then we're going to jump into in the next few minutes. We're going to jump into a quick example. So keep in mind that we tried to calculate this example. We tried not to get too far. We're accountants. We like numbers. We like to play with numbers. We try to stay out of the weeds. This is a very high level example. Obviously, there are a lot of nuances here. There's a lot of detail in these frequently asked questions. So just keep that in mind. The goal here is to show how we think this is going to work based on what we know right now. So because to be honest, the HHS has not really given us a model. They've given us a couple of examples in the FAQs. They've written the instructions down, but they haven't actually given us a detailed model yet. Shady Oaks, so our example here, Shady Oaks Retirement Village, if you were in our last webinar, you're going to remember these guys. We haven't changed the fundamental assumptions terribly much here. 100-bed SNF, they were at approximately 90% Medicaid, 10% Medicare and other. 2019 occupancy was about at 85%. In 2020, their occupancy is at 70%. They got a $590,000 in PRF payments through both the general and targeted distributions. They took out a PPP loan of $625,000, which they expect to be fully forgiven for. And they used part of that $625,000 to pay for some hazard pay bonuses, and they spent another $50,000 of it to pay for supplemental staffing costs directly related to the coronavirus. So about $175,000 of that PPP loan went directly to coronavirus-related costs. And then the facility has been able to identify an additional $200,000 in coronavirus-related expenses, PPP, isolation ward, upgrade costs, all those other sorts of things that we've talked about. So let's look at this and see how it might play out for Shady Oaks. So step one, the coronavirus-related expenses. So this is something that a little bit since our last since the last webinar. As we've continued to receive updates, we've kind of changed how we think this is going to have to work. So what we believe, based on the guidance, you're going to total up all your expenses, and I've kind of grouped them here by major categories. But really, if you're in that detailed group, if you're over $500,000, the guidance seems to suggest you're going to have to be calculating these by expense type, so at a relatively detailed level. For example, they talk about calculating your change in PPP expenses in one of the examples that they provided. But in this case, we've got 2019 total healthcare expenses between healthcare expenses and G&A were $6 million. In 2020, total expenses are running around $6,525,000. And some COVID-related expenses and $375,000. That's the hazard pay, the supplemental staffing, the additional coronavirus-related expenses, and then an additional $150,000 in G&A cost. And so total costs are up $525,000 year over year. When you then look at, we're going to assume, and this is where we get kind of into some unknown here, because what the guidance tells us right now is that providers are going to have to apply, in quotes, reasonable assumptions to determine the amount of their total revenue from net patient care sources and other assistance received. Applies to each type of healthcare expense related to coronavirus. The providers are going to be required to make reasonable assumptions too about what expenses are exactly related to the coronavirus. And we're still, guidance is on those issues. It's not a very well-defined process at the moment. But let's assume that out of that $150,000 in G&A expenses, the provider decides that $50,000 of that is not related to coronavirus, so we'd have to back that out. That leaves us with $475,000 in increased expenses, of which the provider determines that it was directly reimbursed for $175,000 of that. So we're looking, once again, that's reimbursement from sources other than the PRF funds. So in this case, we have PPP loans. Notice that I didn't include the entire PPP loan here, and because some of that PPP loan ostensibly went to pay just ordinary healthcare related payroll costs that would have been incurred, coronavirus or not. And so you only have to include the piece or the expenses that were directly reimbursed. And so that leaves $300,000 then in the change in expenses that are attributable to coronavirus, but not directly reimbursed. So Shady Oaks has additional $300,000 in expenses. The revenue calculation, if you remember our last go around, this has gotten considerably simpler. It's net patient care revenue in 19 compared to net patient care revenue in 2020. One caveat is that you have to include other assistance in, has to be reported as operating revenue and included. And so here, that other assistance would include the entire PPP loan, the entire 625. You're including all the other assistance you've gotten from all sources. And so in this example, then 2019 revenues were 6.8 million. 2020 total revenues are 6,225,000. And that means a lost revenue of $575,000. So then how does that break down? So Shady Oaks had $300,000 in net coronavirus related expenses, not otherwise reimbursed. They had a loss in a negative change in operating income, $75,000. They've got $875,000 of PRF funds that they could demonstrate usage for. Total PRF funds were $590,000. And so the potential recoupment here is zero. If you remember from our last, if you were joined us for our last webinar, you remember that Shady Oaks, under the net income approach, actually had a little bit of potential recoupment. And so the major change here is the ability to use a direct, all of your lost revenue to offset any of your PRF funds that aren't being used to reimburse for coronavirus related expenses. So just kind of a little breakdown or some analysis here. Once again, we talked about this a little bit already, but the year-over-year comparison that providers are being locked into, it eliminates the impact of any pre-COVID growth trends, PDPM gains, operational changes. I can't tell you how many providers we've spoken to in the last month or so that have said, well, I added a new wing, or I added beds, or I acquired a home health, or if they're a physician practice, we added 2 new docs this year. Right now, there's no mechanism to account for those. It's year-over-year revenue comparison. And so if your revenues are up, for example, because of PDPM, if you were able to kind of tweak your operations and PDPM, you're one of the providers that had a net gain from PDPM, you're not going to, there's no allowance for those gains. If it's going to reduce your usage of PRF funds. The PRF funds are used last. So you use PRF funds after all other sources. But still, under this example, Shady Oaks shouldn't face any recoupment. And then we've already touched on this, but providers are required to make reasonable assumptions when applying revenue against each type of healthcare expense attributable to coronavirus. This is something that we're expecting further guidance on, because, to tell somebody you have to make a reasonable assumption, well, we've got thousands of providers out there that are going to be making these assumptions. It's almost a certainty that everybody is going to have a different kind of opinion on what's reasonable. And, we all want to be careful that our opinions match what HHS thinks is reasonable. And so this is an area where we're thinking we're going to be seeing additional guidance.
Well, Andrew, would it be then as a very gross statement to say that much like Medicaid, HHS considers the PRF to be payor of last resort?
That's a good way of putting it, Alan. Something that folks might be familiar with is that the PRF funds are considered, PRF is considered a payor of last resort. So I think, Al, you've got the next slide on some additional data elements.
Yeah, I'm pretty much going to try to zip through these since we're almost at the end and want to do a couple of questions anyway. But in the original post-payment notice of reporting requirements that printed or finally issued September 19th, 2020, besides the elements that we discussed earlier, the demographic, the expenses attributable to coronavirus, not reimbursed by other sources, and lost revenues, there are some non-financial data that they're requiring to be reported. Now, the this information must be submitted for calendar years 2019 and 2020 as a part of the reporting process. And that's personnel metrics, such as total personnel by labor category, total rehires, total new hires by labor category, patient metrics, such as total number of patient visits, total number of patients admitted, total number of resident patients, and facility metrics such as the total available staff beds for med-surg, critical care, other beds such as SNF. On the next slide, this was discussed earlier by the program by HHS in the frequently asked questions on July 8th, 2020, with regard to facilities that underwent a change in ownership. And basically, they had stated at that time that as previous owners are not permitted to transfer funds to the new owner, they were restricted or instructed to return the funds to HHS. At that time, HHS would not reissue return payments to the new owners. Providers that had not received any payments could, under the PRF, could make an application in the future allocation that might be announced. Well, the Phase 3 general distribution did specify that those providers, those entities could make application, and that application period ran from October 5th to November 6th and closed out November 6th of 2020. Following this, going on the next slide, we wanted to just briefly touch on the single audit requirement that we've mentioned and scattered, sprinkled throughout the slides. And we've actually had another section. Our audit team had actually put on a single audit webinar since our last webinar. And Allison Jones and Philip DeBoer that did it may be putting on another one once some additional information has been issued. But COVID-19 funding that is out there that is subject to audit. Allison put together this neat little chart showing the different funding mechanisms that were made available primarily due to the pandemic, indicating whether they would be subject to the single audit requirement or not. And in the highlighted areas, you see that all the HHS funding, all the HHS related funding does have a specific requirements to do with the single audit requirement. And we discussed the audit levels, the 3 levels benchmarks you had to hit earlier in an earlier slide. If we go to the next slide, just in mentioning the Single Audit Act came about in the 1980s, 1984 specifically. So to if you had an entity or a provider out there that received federal funding from multiple sources, rather than having multiple individual agency audits, they could all be combined under a single audit concept. And that would, in essence, cover all of the disparate funds in place. The intent was to provide a cost-effective audit for both the non-federal agencies or entities internally and happen to meet the requirements, and also for the multiple programs that were affected. The compliance supplement addendum that is issued annually had come out in August, and it is not been updated yet. It's expected to be updated any day to address the audit of entities that received COVID-19 relief funds. When and if it is, as I say, Allison and Philip, I would expect, will put on an updated webinar on those requirements. But at that point in time, we'd be able to flesh out what steps are actually going to be taken for those that received or expended, more than $750,000 in a federal relief fund. Yeah,
the main takeaway here for our providers is that if you actually spent more than $750,000 in the calendar year, then you are going to be subject to it. If you spent more than $750,000 in funds for the calendar year, you're going to be subject to a single audit requirement.
Now, early on, isn't that a bit of a change from early on? Was it have they always said $750,000 in expenditures?
For the single audit, it's always been $750,000 in expenditures, or at least for this cycle, for as it relates to PRF funds, I think it's been $750,000 for the entire time. And remember here, spending PRF funds means, if you're reporting or demonstrating the use of those funds, even if they're using them to replace lost revenue, that's an expenditure of funds. You're accepting those grant funds and saying you demonstrated, you're not giving them back to the government, you're using them to replace lost revenue. And so you could potentially be subject to a single audit requirement. So we are at 4:01, guys. And so if you've been to one of our webinars before, we really like to be respectful of everybody's time. We appreciate everyone taking the time to join us today. We have some questions from the audience that were presented actually prior to the webinar starting that are listed here. We're not going to have time, I don't think, to get through those. We've got some questions in the chat. We will compile all these questions, and when we email out the materials to everybody, we'll try to address everybody's questions. So appreciate everybody's time today and talking to us, and I'll turn it over to Nancy real quick for a couple closing things.
Yes, so like Andrew said, we will send an email tomorrow that will include a link to our recording of the webinar and also the slide deck for you guys. And we also have a upcoming webinar on January 21st where we're going to go over the provider relief funds reporting and portal access. And more details will be released soon, and all you guys will get an invite to join that webinar as well. And that's it. Thank you again for joining.